earnings are out this week. There's meant to have been a big lag between these higher interest rate environment and that filtering through into less revenue, especially for the big tech stocks that are driving so much of the US stock rally. If they come in weaker than expected, that's a pretty serious bearish indicator for, the S&P, NASDAQs. And that could have a contagion risk off, and that will certainly follow through into oil. Hi everyone, welcome to another episode of the World of Oil Derivatives. I'm Greg Newman, the Chief Executive on Its Capital Group, and I'm joined with Vincent and Martha from research. Just to follow on from the last episode, we were in the midst of talking about the Middle East crisis and its impact on oil. Some interesting things have happened since, so I'm just keen to just get straight into that. But just before I do, please remember to like and subscribe where you get your podcast, but ideally watch us on YouTube because we are filming this in person. We have graphs, we have things we want to show and go through. So if you can, please watch it there. Right, Vincent. So when we spoke last week, it was kind of the reaction at the end of the weekend, and we had that kind of uptick to 87 on Brent. It was about $3, which was, still only, a little bit. And we had a big sell-off the week before. So since, it's been quite interesting. Do you want to just run us through?
Yeah, so there was another uptick last Friday. So Brent crude flat price is firmly trading at $90 handles right now. It has been supported since Monday morning. So it's really been kind of looking like the market is heavily buying the rumor and really ready to sell on any news. So because the crisis is still going on, it seems like it was going to escalate over the weekend with Israel preparing plans for a ground offensive going into Hamas. So it seems like much of the market, speculators and traders alike, loading up on long positions, whether that's in flat price or spreads, really pricing in that geopolitical risk premium and the potential of wider disruption.
That's the generic answer, right? And I think what I want to break down is I really want to challenge this. We did talk a bit about it last week, but now we've got a bit more evidence. The CFTC report was showing quite a bit of length coming in, especially on the WTI side of things, right? Managed money, long to short ratio is really high. We had a lot of people entering bullish on the USO, the ETF. We've got decent call option buying. I think you can talk about volatility skews in a bit. So there was a rush in, but to be clear, this is more the retail macro community, let's put it that way. And I think you can expect this fast money from then. But, we're a trading firm at the end of the day. Obviously, you guys are focusing on the research, but, I'm still managing a trading floor. And at the end of the day, we were slightly nervous at the end of the week because whilst on the Tuesday rather, when we discussed, we're kind of thinking, the volatility actually is going to die out a little bit because this isn't a huge reaction to whatever the market's throwing at you. A weekend move, a risk premium situation, whatever, that's how people like to talk. But at the end of the day, there wasn't much that went on. A few dollars per barrel on a large scale of things is not massive. But then we had a pretty significant 4% rally on Friday, which is really interesting. But it shows you the trader psychology. At the end of the day, you're a risk manager and or you're a trader, and how do you justify to your risk manager or your boss that you're short over the weekend? You basically can't if there's a war going on, or it's going to be very difficult to do. So at the very least, you expect some form of hedges, maybe some buying of call options temporarily over the weekend, or flatten your position over the weekend to re-enter on Monday. And I think even us, we need to hedge our books and position ourselves to protect, because at the end of the day, it's not so much that, we certainly don't believe that there's going to be any direct impact on oil production in the near term. You just can't know how the rest of the market's going to react. So at the end of the day, I think that justifies a lot of the move on Friday. Is basically the short positions that were building up from CTAs, maybe from just generally anyone holding short positions would find it hard to justify that short position overnight, leaving it unhedged, without buying call options or something like that, which finds its way to the market anyway. So that kind of rally, I think makes a lot of sense. And that's further backed up with the fact that overnight we had literally a zero move pretty much last night. And I think that speaks to, the market not necessarily holding positions and looking to continue to buy other than the macro side. It's more I was out of it, I'm waiting and seeing, and nothing's happened again. So nothing's really happened on the price. So where we go from now is interesting, because I think I mean, we kind of said this last week, but I think I'm going to say it again, that I expect, the sting to be taken out of this event. Now, I was surprised that people were even reacting at all to a geopolitical premium thing, because I even hate saying that, because I don't think it exists anymore. But what does exist is traders not wanting to lose money. And I think that's ultimately what happened. But now that you haven't had much reaction and you've got a lot of fast money entering, it kind of looks, I mean, I guess we can base this for the rest of the discussion, but if anything, I don't think there's a huge amount of further upside. But I'll let you guys take it from here before we kind of circle back to that. But anything you want to add to what's going on?
Yeah, so you mean with the geopolitical risk premium, doesn't matter if we think there is one or there isn't, but the fact of the matter is the traders, the fast money, they might be believing in such a thing, and therefore they're putting money where their mouth is.
Correct.
And buying, entering long positions before the weekend. A lot of call options, a buying of call options coming in, and a lot of buying flat price as well. But the surprising thing was how the fact that the market did not move much since Monday morning, and it's at the time of recording right now, it's still very stable around the $90 level.
Yeah, it's like almost like a self-fulfilling thing, because macro money enters or whatever, or the market moves up because of short covering and whatever it is. But then because there's a move upwards, people then say, look, geopolitical risk premium. That's why you've got to buy, and it's that herd effect. But remember, we were $95 like not that long ago, and it dumped down to 84, and now it's back up to around 90. It's not like we're on some bullish trend. We're actually on a long-term bear trend or medium-term bear trend. So if anything, the market's at risk. And another bit of indication, especially if it was US, a lot of the inflows was US macro, US investors, US retail, then they're not awake yet. You can judge the overnight price action based on majority of the Asian community, overnight macro moves in the Asian community, Asian buying, and then morning European buying. And it does tend to be the professionals who are buying trading oil at that point. If you're a retail investor, I think it's a bit of a random assumption, but I think you could easily attest to the fact that the generic investor and a retail trader for certainty is not trading at 5 a.m. I just don't think it's really necessary if you've got the kind of trading setup they do. But anyway, Martha, is there anything you wanted to add on that?
Not about that specifically. I think that once we get to the products a bit further on, I can talk a bit more about like what the initial reaction was in the market, because I was speaking to the traders a bit about that. So that's that.
I mean, and that's the thing. I mean, the underlying market is and when I say underlying, I mean, there's the fundamental side, there's the physical premiums, but there's the forward curve and the product side. And there is a lot more going on now. It's becoming quite a bit more interesting. We had that surprise. Well, I think it was a surprise for us, right? That big gasoline sell-off, and it was really heavily filtering into the refinery margins. That's now continued, isn't it? Gasoline is yet again another week of weakness.
Yeah, the liquidity in gasoline, EBOB especially, has been really terrible. The whole light ends complex has just been so sad. It's been really illiquid, prices gapping around, and traders haven't been able to take that step into the market really. We've seen some closing out of short positions, but still the market is being pushed lower in the cracks.
So this is the prompt crack. This is November crack.
Yeah.
I guess the volatility is dying out a little bit, but it's we've had a lot of buying. At least last week we did. Have we seen continued buying in the crack?
Yeah, we have seen more buying this week. Yeah, it's definitely been continuing. Even following, we have, as you can see, the open interest falling. We have seen the long interest coming back into the market, which is reflected in the 7-day trading split.
So we're overall short, but we saw buying returning in the last 10 days. We talked about it in the last podcast. People are continuing to buying in the last 7 days. So again, it's still people picking up length at these levels. And we had an open interest kind of retracement, but that seems to be picking up slightly as well. So actually, if anything, I guess it's still the theme of support at these levels, because I wouldn't call it like a dramatic sell-off week on week. So I think we could still argue that there's that support line, if you like, coming in with the buying. And we certainly believe in that trade, don't we? You were more emphasizing the gas snap, Vincent, as a way to be long. But in general, we kind of maintain that view.
So more on the, that's more on a gas snap on a relative value basis. And so maintaining the view of bearish naphtha and slightly
actually, it was even the week before you were saying it on the podcast. Remember, you were thinking Nov through to Jan, kind of Q1 cracks, Martha, you were saying it.
that's yet to come to fruition really. But I mean, we have seen an increase we've seen trade houses shut short positions, I think 70 kilobarrels of short positions in the past week, and adding like almost 80 kilobarrels back. So I think there is that, they're almost wanting to get long again. I mean, the prices are like super attractive in the like EBOB. So
I think from what I'm hearing, like the fundamental story is not yet there. But of course, you're trading deferred fundamental story. But at the end of the day, I think right now, cracking margins aren't looking good. The refinery margins aren't looking good. As the indicators are that the physical premiums are on the low side. But, you know, it's all about what next. And I think refiners right now, we're coming back to this theme, aren't we, Vincent, about like we had like a few months ago, which was before OPEC did their latest cut, the world was starting to swim in light sweet. And ultimately, the naphtha cracks were just getting obliterated. The light end complex was just very weak. And so OPEC's cut on the heavy crude side wasn't enough to stop an overall net supply increase in the world based on light sweet. And that was being reflected by the light end cracks. So, I mean, I know gasoline we kind of feel is getting supported, but naphtha got pretty like smashed, didn't it, week on week? So if we could just get that up as well.
Yeah, abysmal.
Yeah, so what is it, like $2 or so on the prompt crack in just a space of a week? So that again, it's fallen off a cliff, and it correlates quite well with the like slight resurgence in flat price. But it just shows you, like you're saying, low liquidity, not much interest in naphtha from the long side. It seems anyway, and it's just gaps back down. But that's like really not good for margins. So if anything, you know, naphtha even cheaper. You know, you could blend that into the gasoline pool, so it doesn't really help the gasoline supply story either. So I think we're purely technically, on a technical basis, bullish gasoline. But actually, if you look at it, the fundamental story, the light end oversupply argument is coming back. And I think we need to follow that narrative up by what we used to say before a few months back about the WTI story. You know, we were drawing aggressively a few weeks back and into the latest expiry. And there's VLCCs being taken out kind of, you know, at the worst possible time, really exacerbating all the tightness as we got to that expiry. But now, you know, fast forward a week or two later, and there's a 10 million build last week, wasn't there, in Cushing?
Drawing Cushing, but
a 10 million build elsewhere. And WTI Brent has fallen off a cliff, and we're like 450 on WTI Brent. Which, you know, kind of all indicates that, at least for the time being, the supply side has eased and we've still got enough WTI Midland effectively, which all filters back into the global complex now that it prices Brent. So I guess it is just about, you know, for the supply and demand enthusiasts, like, where do you go from here? Because it's on repeat, this story. OPEC cut, then, you know, flat price is high enough that, you know, shale oil production finds its way to increase. We get all-time high production in the US. For some reason, the media ignores it, or traders ignore it. People don't talk about it, but literally all-time highs. And then, so the light sweet overwhelms the overall cuts, and we have a net oversupply. But then they cut again, didn't they? So it's like, it's all just had to, you know, rebalance and go high again. But now that we've reached, you know, triple digits on the Brent spreads, triple digits on the dated diffs, we had a very strong WTI expiry. You know, what that's then being followed up with is incredibly weak European refinery margins, you know, a terrible gasoline market. And we're not that far away from trading Jan barrels and Brents. It's only in a couple of weeks' time we'll be trading Jan loading barrels for Brent. And I think that it's not looking amazing. I mean, is there anything else you guys, with the naphtha story especially, right?
Yeah, well, I mean, just speaking of naphtha, at the beginning of the week last week, we opened on Monday morning, and there was this like absolutely massive buying by actually market makers in the East-West, because they were like, they were interpreting the events in the Middle East as maybe an Iranian proxy war. So they were really bidding up the naphtha East-West, and then completely got the wrong story, and it got absolutely smashed down. I've got the numbers here. It got
classic market makers not knowing what they're doing.
Yeah. Sold into, and it ended up with a net 1 million barrel selling, even with the really aggressive buying.
Interesting.
So, yeah, and then since
then, the Eastern buying just didn't come through.
No, since then we've seen the East-West get smashed down in
in
loads of products. It's been really, really heavy.
Yeah, but that actually is quite significant, because we were talking about the Golden Week, lack of Chinese buying would cause an East-West sell-off. It did. We then had a return of the East-West trajectory going north, and then it's kind of come off again. So new information or a lack of fear, maybe a lack of, if I always like that argument, if something isn't going to happen in an extreme scenario, then why would it happen when it's normal? So in other words, if nothing's really happened with this conflict, then people kind of look around and go, actually, this isn't that big of a deal. Maybe it's more leaning towards the bear side. I mean, or is there more of a supply, what'd you call it, Chinese exports, that kind of thing, Asian export story?
No, well, when I spoke to the Tara on After the Trader on Thursday, I asked her about it, and she says that it was kind of this kind of contagion fear, looking at the Strait of Hormuz. Am I saying that? I don't know. And
Strait of Hormuz.
Yeah. And she was just saying that it was like massive contagion fear that's just been put to bed essentially for the time being.
Well, that's kind of what I'm saying. So, buy the rumor, sell the facts, like you were saying, Vincent. Yeah. So it's just one of those things where lack of something happening tends to be quite a dangerous position to be in. So like, again, with flat price, you get long over the weekend, you're a bit concerned, you hedge your books with a bias long. If nothing happens, it's like, there's quite a lot of risk now that it's going to tube downwards, because you've got a lot of people who need to de-risk their hedging risk long. Do you see what I mean? They were arbitrarily long just out of protection. So you've got to sell out of that. If there's enough people arbitrarily long on no real justification other than protecting their books, then they're not going to have any problems reversing that. And that kind of contagion of positioning, sell, could be quite aggressive. And that's kind of the angle you're going for the East-West. And it could be the same with flat price. So I'm really glad you brought that up. It seems to be like quite a consistent theme across the markets.
Yeah, really interesting. And yeah, the only other thing about the refinery margins is that at the moment gas oil is essentially the only thing that's seeing any real positive movement. And if we see more gas oil production, we'll be seeing even worse kind of gasoline oversupply.
Yeah.
And that could just be making everything, like the light ends, even more drowning.
Fundamentally, yeah. And I was surprised to see the gas oil crack rally personally. Yeah. But I guess it's it's got a strong correlation to flat price still. And of course, generally speaking, the heavier side of the barrel more than gasoline, and that's still tight ultimately. We're still pricing strong in Dubai.
It's expiry. We had a really, really weak expiry. And then since then, we've had good premiums on Thursday and Friday. The pricing spreads up $4 than it was. We had really bearish majors.
In Europe?
Yeah. We had really bearish majors selling, but like a few weeks ago, like into the pricing, and that's not there anymore. So like we think maybe there's a reversal going on there. Okay,
so a little bit of relief on the physical side, but yeah, he's talking like quite high levels on the cracks though. So it is surprising. And then if you couple that with, I guess TTF had a pretty significant rally throughout the week as well. Yes. Again, a bit of a risk thing going on there. More believable in my opinion, the risk premium in TTF, because the basis of a premium going up or let's say a discount going down is like, are you in a state, like a perpetual state of oversupply or undersupply? Now, pre-2014, it was a perpetual state of undersupply seemingly in the oil world. So we tend to have this risk premium because it's like, look, we're already on shaky ground. That's, I think, reversed since, obviously without the OPEC cuts. But generally speaking, all things equal, we're in a net oversupply world in oil. Whereas nat gas, we are still in a vulnerable state. The LNG strikes in Australia showed us that. Yeah, so I think it makes more sense. Back on now. Okay, well there you go. So maybe some sensitivities there on the LNG side from that kind of genuine risk premium to supply being offline essentially, and you add the war, and I think that's maybe what's behind at least positioning in gas oil to some extent. You can make that argument, right? Yeah.
Yeah, I think that's valid.
Yeah. Cool. So I guess just to touch on like the Straits of Hormuz side of things. I mean, I know, when you read stuff like, if Iran and US start to be vocal about this there's no longer proxy, it's, against each other directly. We have a repeat of the kind of tensions that from an oil production point of view is all about the Straits, which, roughly a third of the world's exported oil goes through there, fine, blah, blah, blah. But it's the same thing every time. Like the amount of times I've written a report on the Straits of Hormuz, like since I started like 11 years ago, it's like maybe 200 reports. Like it's just one of those things. You always look back at it, historical analysis, scenario analysis. And as I say, it depends what regime you're in. If you're in a regime of like perpetual oversupply, does it really matter? Like flat price actually sold off in 2019 when we had that situation with Trump and Iran. And so I when you see it, technically speaking, if the Straits of Hormuz closes, you could take off this amount of oil per day. It's not incredibly compelling to me. But what are you guys hearing? Or what is the generic argument? You put some notes here.
From a narrative basis, when you talk about the oversupply, it's precisely because Iran has been contributing to that oversupply this year because of relatively because of US sort of looking the other way when it comes to enforcing the sanctions, letting Iran, exporting more crude.
It's very US of you, Iran. Yeah, no, that's a good point. So, okay, well, hang on. So follow that logic through. So they've been allowing their supply coming back, or not getting to...
Yeah, so Iran supplying coming back online. So if Iran is implicated, then the US will start actually enforcing the sanctions, taking a tougher stance on these sanctions.
Yeah, that's a lot more believable, actually. Rather than the straits being closed, actually, coming down on the sanctions, maybe, possibly. But it's interesting to see the reports. Was it Vortex that was saying... the evidence is that Russian barrels are above, the exports are above the quota for the cut, OPEC plus cut. And if that's true, threats are fine and talk about production is fine. But at the end of the day, ship tracking software, and people can see the evidence themselves. And if they're seeing the evidence that Iranian supply, like you say, is fine, or at least finding its way to market like for a long time, and Russia are actually producing more despite this cut, then how are we meant to be concerned about this crisis from an oil production point of view? Even when we actually took barrels off in Saudi Arabia when they got bombed, 10 million barrels like literally offline in a second, and the market kind of absorbed that within a couple of days, and there was a great attempt to get all the oil back, pull out of storage, and look, nothing material happened. How are we meant to believe, like everyone in the Middle East, at least the producing countries, they're all there to protect. The reason why they want to cut, the reason why we're in this situation is because they want flat price higher, right? They want to increase their oil revenues. So it just doesn't make sense that people wouldn't be maximizing their output at higher prices to some degree. And yes, within the OPEC quotas or their cut quotas, but at the end of the day, clearly Russia are showing, it's a great time to be making money. So I just don't believe the argument that suddenly because there's a bit of tension, there's going to be less supply. Does anyone actually believe that? I don't know.
I think risk reward is more skewed to the downside now because Saudi Arabia they have spare production capacity. They can raise production in the case of further tensions as well as because they're already deep in the OPEC cut, right? So it's the voluntary cut is going to be lasting until end of December. And come January, they could choose to conclude this. And US shale, US crude production, last week's EIA stats showed that 13.2 million barrels per day. That's the highest weekly average ever recorded. That's even higher than the pre-COVID March 2020 level of 13.1 million barrels per day. So US oil supply is very robust, very healthy right now as well.
But I think you're making the argument, tensions remaining high, the chances of Saudi ending its voluntary cuts will increase. Do you mean that if tensions remain high and that filters into flat price being higher?
Into flat price being higher as well as supply being disrupted somehow.
Yeah, but I think we're agreeing, is that not unlikely?
It is unlikely.
The voluntary cuts, if you got high enough flat price, or let's put it more like you believe the market's in balance, then you bring supply back online at the end of these, because it's a cut within a cut, isn't it? I think they're cutting back to what they were a couple months ago in January. That's the plan. So you're making the point that if flat price remains high, they will definitely do that. So the risk reward is just to the downside, essentially.
Yeah, I mean, they want to keep it high, but not so to keep it balanced around this $90 level. Yeah. So maybe 100, but not too much beyond that because of then energy inflation concerns, and then US won't be complaining about that.
I think it's just like this belief that incremental supply increases and decreases have such a direct impact on price. I think like that $10 per barrel sell-off, what was it, 10 or so days ago, showed us it can be so dramatic, these things. And it's not because someone turned the taps on a bit too much today. You know what I mean? It's financial selling. And I think the sentiment is on a sixpence. And I think the more you get people riled up and extended one way or the other, the more you have a big chance of a reversal when things don't materialize. So you can't threaten, you need to deliver now, and no one's going to want to see real supply disruption. So I'm always amazed, or not really amazed, it's always interesting to see that we get to this balance of supply and demand despite OPEC cut. This is like the third time this year. You cut, okay, it's really bullish, and the market clearly goes back into supply again, the spread started to sell off, people get bearish. You cut again from the existing cut and it comes into balance. Now it's the third time. I just still, like, I think we've said this a few times before, how many times can you do the same thing? How far are they willing to go to cut even deeper and deeper? And I've got to say, they've gone way deeper than I would have thought. But at some point, I'm kind of agreeing with you. The risk reward, it's like, it's just going to keep happening, and US is going to keep being more robust, despite what people seem to think. And yet the refining margins look awful. And I don't think you can cut anymore, but I've said that before, and they have. So I don't know. That's the only fundamental.
Yeah.
Kind of, yeah.
I mean, definitely. I mean, Saudi have shown their intentions to the market, and us, traders, us analysts, we've recognized their their intent, their determination. And people were talking about crude going back to 100, which was just a couple months ago at 70. It was not many people really expected that, but right now it really seems to be a game of chicken. So a lot of, as you mentioned, a lot of people have hedged the risk, positioned to the buy side, and seeing that, okay, if things aren't going to escalate, if nothing's going to happen, then price is going to go down. But who's going to bite the bullet first? People want to be, if people see others exiting, then they don't want to get caught. They don't want to be stopped out.
I think that's what happened 10 days ago. That's how you get these huge moves. And then you bolt on all the CTAs that are out there that triggered, like, mathematically, is as soon as there's enough selling and enough of a move, they sell as well. And it exacerbates every single move. So I think you're in a lot of danger. Imagine it's like, oh, I'm going to take a long lunch. And then you get out of your lunch and it's $10 lower, like $6 lower. So, okay, that's your entire budget just destroyed as a producer or whatever else. You're going to be nervy, is my point. So I absolutely agree. Just also on the, just quickly back to TTF, because, sensitivities around that is still, we were kind of trending lower, power, carbon, and TTF, we were in a kind of long-term bear situation as well. Okay, so that's like quite a lot with the flat price. There's a couple more things to discuss. Like one, like volatility quickly, because you were looking at some skews, right? Was it you, Martha, or?
Yeah, so these are just from this morning. We've got the Brent futures and the WTI skew. I think the WTI is a bit more dramatic. Do you have? So
this is the
this is Brent.
Futures. Yeah. Okay,
yeah, we can see, like you said earlier, we're going to have, this is for today. We can see that the call volatility, implied volatility, is really increased over the week significantly, but the put hasn't so much. And actually in the WTI, the put has decreased week on week, the implied volatility of that, which is really interesting and kind of surmises the attitude over the past week.
Yeah, absolutely. And I think, it's pricing a lot of it in. And again, I like these graphs because ultimately it's to say it's going to increase now, or volatility is going to increase, you have to take it from this starting point. So we are in a high volatility environment and people are expecting a lot of upside. So in order to buy into volatility now, and you have to really believe that this is going to really escalate. And I think almost every half an hour, something doesn't happen in the news. The more you're running that kind of risk, even having volatility that high, if you've got a position on or you're hedged that way. So, I mean, more of a decent chance of reversal than anything else. I think generally speaking, it's all skewing towards the downside, even on the volatility side. But from a trading point of view, before maybe we say make a call on Brent or something like that, is there anything else on in the wider market? You still maintain the same view on GasNap?
On GasNap, still bullish.
Yeah, okay, understood. But yeah, no, I know what you mean. Like, we're still the swaps is like very untouched from a technical basis and overextension. So kind of cutting our teeth more and more with these things. But you guys run a call it Onyx Alpha, right? You run like on the research product, an actual ongoing performance of these trades, and they are working quite well. So I think I get it. You can kind of argue the systematic nature of it's worked quite well. So you're just kind of repeating that on the barge crack. But I'd be interested to see, that refinery coming back online, if people start to buy into that fundamental story. Because as I say, being bearish, anything super heavy in this kind of environment, if that ends up being true, that's even more of a bearish argument. And you've still got OPEC kind of probably coming back online, adding more heavy whilst the refiner's ready to pump out more excess fuel. So yeah, I'd be very curious to hear more of that. Maybe next week we'll review that and see how it went, because it's just like marrying the two stories together is always like quite interesting. So I think, rather than cop out like we have before the last couple of weeks on Brent, I think we've got to make a call. I think everything we're saying, personally gearing more towards like bearish. I think in particular, I think the riskiest trade, but potentially the highest reward, is selling calls because you're also going to fade that volatility that is being priced in because of everything we're saying, like loads of hedging, retail money, macro money, all buying in, expecting something big to happen, but we're quite confident it won't. Meanwhile, on the backdrop of a growing, fundamentally bearish story. So I think at the very least, I think it's going to be hard for the market to like accelerate higher. It could maybe creep higher, but I think it's not going to accelerate higher. So that speaks to bearish volatility, if that makes sense. So selling calls is like the ultimate bear move, I think, right now. But it's of course quite dangerous, and I think any risk manager would say you're mad to do that and probably wouldn't allow it. But from a logical point of view, that makes sense. So I think directionally, it's just bearish in general. And maybe it's the puts actually on the skew basis that are undervalued. So you could actually sell calls and buy puts and still not be short volatility, but you're geared towards the downside. That'd be quite interesting. But again, just purely directionally, what would you think market call on Brent in the next, let's say medium term, 3-4 weeks?
Medium term would be bearish, so falling back below the 90s into the 80s.
Yeah.
Not much further downside from.
You don't think?
No.
Is there not a chance though that we could get a repeat of what we got before the crisis happened, and we were starting to head south more and more, and that $10 per barrel in like a couple of days, that could give way again if there's quite a lot of fickle length. There is a risk that it moves quite aggressively down. I'm going to say in the next like medium term, I think we could test 80 on Brent. There we go. Might as well say something interesting.
Yeah, well, it will depend on this week's, this Friday CFTC data. That will be a big indicator, but you also need some macro headlines, for example, like there's like some banking crisis or whatever that will be the further bearish impetus.
Good point, actually. We're talking a fundamental story being bearish with refinery margins, etc. But I think the macro story people tend to act with more conviction, it seems. And one interesting thing that's been building up for a while is the earnings in the S&P and what the big US stocks. Earnings are out this week, and there's meant to have been a big lag between these higher interest rate environment and that filtering through into less revenue, especially for the big tech stocks that are driving so much of the US stock rally. So if they come in weaker than expected, then that's a pretty serious bearish indicator for the S&P, Nasdaqs, and that could have a contagion risk off, and that will certainly follow through into oil. And you know how it goes. You just need one strong conviction, and last week it was a bullish conviction because of short covering whatever else that in our view, and then you get all the narrative behind it. Vice versa, you could get a decent impetus of selling from de-risking this risk on stuff, hedging risk, whatever, and then you get bearish earning calls, bearish stock moves, and it could filter through. At the same time, I think this narrative has been maybe talked about quite a lot in the macro environment, so maybe they actually are, if anything, expecting slightly weaker earnings. So it would have to be a bit of a surprise to the downside to be weak. So that's probably the one to watch, I would argue. Slightly left field, but I think for sure it could filter into oil, and someone needs to have conviction here to move it further. That would be my call. Okay, good session, guys. Thank you out there for listening, and we'll be back next week for more of the same, I think, but also a special podcast is on its way. Actually, that's it. That's all I'm going to hint at. It's quite an interesting one. And also a reminder again, if any of you do have any views or questions, please shout them out. LinkedIn, YouTube, whatever. We're really happy to hear from anyone and everyone, and kind of fuels the discussions here. Thanks again for listening.